Welcome, everyone. We have such a crowd that we are still having people filing in and getting tickets, but I think in the interest of time, we're going to go ahead and start with introductions. I think by the time we get to the main event, most people will be in and have found their seats. And as people come in, there are plenty of seats down here very close to the stage, so feel free to use these seats as well. So what a great day. What a beautiful day outside. I'm glad that all of you are here in Baker Hall with us for this really special event. Welcome to Lehigh College of Business, Donald M. Gruhn, Class of 49 Distinguished Finance Speaker Series. I'm Nathan Urban, Provost and Senior Vice President for Academic Affairs. On behalf of President Joseph Helbley and Lehigh Business, it is my pleasure to welcome trustees, faculty, staff, students, and members of the community to today's chat. And a special welcome to our speaker, Dan Pietrzak, a partner at the global investment firm KKR, as well as a class of 1997 accounting alumnus. The College of Business is pleased to bring nationally and internationally recognized thought leaders such as Mr. Pietrzak to campus to address important business topics of the day. Here at Lehigh, we pride ourselves on preparing our students for success. And what better preparation than to have students engage with successful industry leaders? Meeting with and having conversations with important leaders such as Dan is a truly distinctive element of the Lehigh education. And I am really excited and really glad to see so many students who are here today participating in today's conversation. And I understand there was a pretty animated conversation earlier today with Dan and a group of students. I'd also like to thank Don and Judy Gruhn, who have made this event possible through their philanthropy. Unfortunately, the Gruhns cannot be with us today in person, but they are watching via live stream. The Gruhn Speaker Series, which was established in 2008, is just one example of the ways in which Lehigh extends the student educational experience well beyond the classroom. And I would say personally that events such as this, events that bring important people, sort of accomplished alumni to campus, is a really important part of the lifeblood of any college or university. It's critical to the college experience for students and faculty and staff at an institution to see the success of alums through the work that they've done after leaving the university. Distinguished alumni such as Don Gruhn from Lehigh's class of 49 find many different avenues to give back to their alma mater. Don's generosity is felt in many ways across campus, from an endowed scholarship fund, his contributions to the financial services and the Martindale Society, to supporting the Zollner Arts Center and the journalism and athletic departments. He is a true friend of Lehigh. The Gruhn Speaker Series is yet another way in which Don and Judy support Lehigh. We're grateful for this opportunity to welcome yet another thought leader to campus. So now I would like to invite Manoj Malhotra, the Kevin and Lisa Clayton Dean of the College of Business, to the podium to introduce Dan.
Thank you, Nathan. Allow me to add my best wishes and gratitude to Don and Judy Gruhn. Let's welcome our speaker and our moderator, Dan Pietrzak and Nandu Nair, to the stage. Our moderator, Professor Nair, joined Lehigh Business in 2001. He holds the Hans Julius Bahr Chair in the Perella Department of Finance. He was chair of the department from 2015 until this past summer. Nandu's research is published in top-tier journals and includes the areas of corporate finance, pricing of securities, residual value insurance, and structured finance products. Thank you, Nandu, for taking on the role of moderator today. Dan Pietrzak is from the class of 97. His wife, Mary Ella, is also class of 97. Both are accounting majors. They're parents of a class of 2028 student, Sophie. Their son, William, is still in high school. Too early to tell where he's headed, but we have hopes and expectations. They're all here today. Thanks for joining us. Dan is partner and global head of private credit at KKR, a global investment company that manages multiple alternative asset classes, including private equity, energy, infrastructure, real estate, credit, and through its strategic partners, hedge funds. Prior to joining KKR, Dan was a managing director and co-head of Deutsche Bank's structured finance business across the Americas and Europe. He started his career at Price Waterhouse in New York. He holds an MBA in finance from Wharton, but it all started with his BS in accounting right here at Lehigh University. Yeah. Dan serves on the college's Dean's Advisory Council of Alumni and is a member of the advisory board of the Lehigh chapter of Scholars of Finance. I have been a beneficiary of his vice counsel in the brief 3 months that I've been here as the Dean of Lehigh College of Business. He also serves on the board of directors of First Tee Metropolitan New York. That's a nonprofit that enables kids to build the strength of character through First Tee's Life Skills program. Delivered by certified PGA coaches, the program teaches and applies lifelong lessons to the game of golf. Incidentally, he was on the golf team at Lehigh on a golf scholarship as well. I'm happy to see that Dan's years on Lehigh's golf team prepared him for doing good in the world. Dan suggested today's topic, financial market evolution post the global financial crisis. We are going to tackle how the 2008 financial crisis has shaped global markets. Many of our students were still young children at that time. We will explore shifts in the regulation landscape, the rise of private credit, and the increasing role of alternative investments. These are changes that continue to influence strategies and opportunities in today's financial markets. Dan will also address what the future holds for investors, institutions, and other stakeholders. As we go through this fireside chat for about 45 minutes, I will come back and take some questions from the audience to be directed to both Nandu and Dan Pietrzak. Now I'm pleased to present to you Daniel Pietrzak and Nandu Nair.
Okay, that means I have to speak. Good afternoon, everyone, and welcome to the Gruhn lecture. A few notes to preface the conversation today. Don Gruhn, I've known him for a long time, and he put this together. He donated money for this so that the students can benefit from the insights that distinguished alumni such as Dan can provide, something that we cannot provide in our normal curriculum. Right? So I know Dan for some time now, and Dan has been very helpful on several dimensions, including my own research, because he's provided very useful insights as well. So a note to some of my professor colleagues, I know some of you out there, connecting with alumni helps your research, right? So moving right along, I think our students are very fortunate to have such distinguished people like Dan come and talk to us. And so let's talk about tonight's topic. But before we do that, Dan, can you give us a little bit of background on yourself and your educational journey?
Sure, no, happy to. And it's wonderful to be back here. I'd like to start by Don and Judy Gruhn. I think events like this are wonderful. I had the benefit today of being in one of your classes. I had the benefit today of going to lunch with 15, some combination of seniors and grad students, and I think the alumni are very rewarded by coming back to campus and sort of spending time here. But again, thank you for having me. I think we might have said the word distinguished a few too many times, but I appreciate it. I think if you think about my journey, I grew up in southern New Jersey, a town called Delran. In a lot of ways, was probably lucky to get to Lehigh. right? First person in my family to ever go to college. So, I think through good fortune of good friends kind of guided me here and probably got me through. But it was a phenomenal experience here. As stated, I majored in accounting, kind of minored in political science. Education was important. I wanted to get an MBA. I didn't do it the traditional way, but I did an MBA for executives program at Wharton that I graduated in 2005. I think education, nobody can kind of take that away from you. It's the foundations of kind of all you do. But in a lot of ways, Lehigh has been a lot more to me than just the education, right? As noted, my wife went here, class of 97. My daughter is a freshman here. Most of our kind of lifelong friends have been from our graduating class, right? And I think that's what makes this place special.
Okay, so you were here in accounting. So can you now talk to us, if you can, what drew you to finance and how you navigated from a career based in accounting to high finance at KKR? What was that transition like, and how did you manage that?
Well, in a lot of ways, I think the major in accounting was probably a little bit tactical, right? I think the major was different then. It was a 4-year program. I think you need to go 5 years now. That was kind of a big major here in the 90s. That was the place where if you had the right GPA, you got a job, one of those big 6 firms. And it was a great training ground. I mean, honestly, these accounting firms provide experiences to young people that, just really either don't exist or they probably let 24-year-olds do things that 24-year-olds probably shouldn't be able to do. But, a real good, I think, training. Finance always interested me, numbers always interested me, especially sitting in New York City. And, I kind of felt that sort of draw. I got lucky. We talked about at lunch today how networking matters, right? I got lucky. I made my way into investment banking and finance at CIBC World Markets. This is kind of the late 90s. At that time, the bank was run by really former ex-senior management from Drexel.
So we all know about Drexel.
All know about Drexel. Bad probably ending, but a great kind of story along the way. It was a place that allowed that younger generation to step up, to succeed, to kind of do more. Ultimately moved on from there. Had a stop at SocGen. Made my way to Deutsche, which Deutsche Bank was probably my formidable years. Started at Deutsche Bank in 2006.
That was in New York City.
New York City.
Okay.
So my first 18 months at Deutsche Bank were in New York City. I moved to London in December of 2007. Right, which we're going to touch on this today, we'll call it the start of the financial crisis.
We'll get to that.
We'll get to that. Really moved over with a view that there was money to be made on kind of the distressed market in the U.S. We were capitalizing on that. Nobody in the world would have thought it got as bad as it did, right? Okay. But the Deutsche experience, I mean, it was a risk-on institution. Deutsche Bank has had some challenges, but it was an excellent institution from a, let's call it, governance around risk-taking, being smart about financial markets, and it provided a good segue to KKR.
Okay, so but Deutsche Bank prepared you for KKR.
For sure.
And you spent some time trading loans, bonds. What did you do at Deutsche Bank specifically?
Yeah, so I ran. At the end, I essentially ran the credit business, right? But they actually took out at that time sort of traded loans and traded bonds. Okay. I think where the market evolution was going, which goes a little bit to our conversation today, is banks were trying to create as large of kind of flow trading businesses as possible. That was the capital efficient models. Where the Deutsche business was interesting is they were very prepared to deploy the bank's capital. And do that in a way that capitalized on the market opportunities, right? So we were early in buying assets from banks, and we're going to talk about the state of the banking system. This was not just a U.S. problem, though, right? The European banking system was arguably more challenged.
Correct.
In 10, 11, 12, you had this concept called the PIGS, which was Portugal, Ireland, Italy, Greece, Spain. Yeah. Like you were talking not about just defaults, you were talking about sovereign defaults, you were talking about redenomination risk. So, the Deutsche sort of jobs, we bought a lot of assets from these banks, right? That was foundation one. We set up a lot of businesses there that you would call private credit today.
So then you move from that European mindset into KKR. So you're at KKR now. Can you share a bit about KKR, what KKR does, what the spaces it plays in, as well as what your role specifically in KKR is?
Sure. So the firm itself, founded in 1976, so let's call that a pioneer of private equity. Henry and George have really done something special in terms of the firm and the culture they've created. That said, it was a private equity-only firm for really an extended period of time, right? The credit business was the second business. We started that in 2004. We're having our 20th year anniversary kind of now.
So 76 to 2004, they were only in private equity.
Only private equity. Only private
And
equity.
suddenly there was this brainwave to move into something else.
Yeah, I think it was driven off a couple of things. I mean, there's a classic story that goes around the office that we share with our investors all the time. They were out talking to companies on the other side of the dot-com bubble. There was a lot of volatility in the markets and a really bad recession, kind of 2002, 2003. They would go to meetings, those companies would want, or those CEOs would want capital, but the company wasn't for sale. And the moment they said the company wasn't for sale, the meeting was over, right? So they need to find sort of other forms of capital. So the credit business was the start of that. Okay. I think that was even before the financial crisis, right? But I think the financial crisis accelerated that. And accelerated that, really to where we are today, right? The firm has north of $500 billion of assets under management. Private equity is not the biggest investing vertical, but it's one of 5. The credit business is actually the largest investing vertical.
So what are the verticals, if you don't mind?
Yeah, so private equity, the credit business, let's call it 230-odd billion of AUM in total. Infrastructure, real estate, and then a big insurance effort.
They're getting into insurance also.
Yep. We bought an insurance company called Global Atlantic in 2021. I would probably frame that, I'm sure we'll get to it later, as another kind of change on the other side of the financial crisis. In terms of my role, so I run the private credit business. So the private credit business at KKR is $100 billion of AUM. I would say we do 2 things, if you put it kind of simply. We lend money to companies, so that's number 1, right? These could either be private equity-owned businesses, or they could be family-owned businesses, but they're generally larger companies, right? Smallest company we probably lend to is, $25 million of earnings, all the way up to probably $250 million of earnings. But, we're out there, originating those deals ourselves. We're structuring those deals ourselves. We're not buying from the banks. We're not buying off sort of a screen. But that's, let's call it half the business. The other half of the business we call asset-based finance. So this is, I'm going to call financing the real-world economy, right? People in this room either have or will have auto loans, auto leases, student loans. We probably own a couple hundred aircraft that are on lease. So a large mix of financial and hard assets, but again, really financing that real-world economy. And that's probably been a business that's been born out of the financial crisis, right? Because everything that we're really doing in that space is stuff the banks would have done prior.
So what do you do in your day-to-day roles? I mean, besides just running the private credit?
Sure. So I would probably put my day-to-day in a handful of buckets, right? Obviously, the team now is 125 people, so it's not a small business to manage. At $100 billion of AUM, there's not a day that goes by where you're not involved in some form of transaction, right? So you got to run the business. Number 2, I spend a lot of time on the investment side, right? I think if we want to be honest, I'm not out there kind of hunting individual deals anymore. But we spend a lot of time in the underwriting process. Our IC process is very intense. And then along that lines, I'm the main PM for most of those pools of capital. And then I do spend a fair amount of time, which I know is an area kind of near and dear to your heart. We do have a publicly traded BDC, which stands for Business Development Company, right? That was really the start of some of these private investment vehicles that would provide money to small and medium-sized businesses. That entity trades on the New York Stock Exchange. That entity is probably higher maintenance than most things we have because it is a publicly traded name. But I think net, with a team of 125 people, I view this very much as a team sport. And I think we're lucky that we've got excellent sort of people on the team.
Okay, so how did your past experiences prepare you for all this heavy-duty stuff you're doing at KKR in the private credit?
Yeah, I would put it into probably two buckets, right? I think the different jobs that I had before Deutsche were broad, they were dynamic. I probably, in a lot of ways, was biting off more than I could chew kind of along the way, but it was always giving me stretch assignments. I think for any of the students out there, I think stretch assignments in your career are kind of excellent ideas. I would say Deutsche Bank would have been the real training ground, right? We started a direct lending business there in 2009 before many direct lending managers were set up. We were buying more assets than the likes of the U.S. buy-side firms during that financial crisis and sort of that 5 years after. I think the Deutsche business at the end of the day was probably 500 people, right? It was a 65 billion euro risk book. It made a couple billion euros of kind of annual sort of P&L. And I think there are lessons learned from running larger sized businesses, running larger sized teams. We kind of joke a lot at work, like we're not curing cancer, right? We're finding a way to do good deals that don't lose money. Yeah. But if you do that, you need to do that in a way that, and these aren't kind of maybe the most interesting words, but you need investment process, you need governance, you need kind of a way to ensure you're not making mistakes.
So being in Deutsche at the cusp of the great financial crisis, you saw a lot of stuff going on there, right? So the great financial crisis, I think, is intertwined into your career progression.
Undoubtedly. And honestly, you, especially in finance, you learn the most in times of either market volatility or times of significant market stress.
You never waste a good crisis. That's the lesson here. So I think that's a useful segue, a nice segue into tonight's discussion, right? Financial market evolution post the global financial crisis. So let's set the stage here. And it's a pretty scary stage, right? So the markets were in turmoil at that time. Many financial institutions had failed. Bear Stearns, Merrill Lynch, Lehman Brothers, and they all happened in a short period of time, within a couple of weeks. And everybody was waiting for the next shoe to drop, right? And then we saw a $180 billion bailout of AIG. That's a huge amount of money bailing out a particular company. So people were just wondering what's going to happen next. People were scared, right? And so in your opinion, what do you think were the root causes of this great financial crisis, this scary event? And what vulnerabilities were exposed at that time?
Yeah, well, I think there's a bunch of vulnerabilities exposed, right? I do think you probably have to take a step back. There was a major law enacted post-depression called Glass-Steagall that sort of separated the commercial banks from the investment banks. You could argue in a modern-day finance that didn't make sense anymore. That rule was essentially unwound. That let a lot of mergers happen, but that let these sort of investment banks be larger. Yeah. When you become larger, you arguably have more systemic risk to the global economy, right? So that's one sort of piece of the backdrop.
Because banks and investment banks that distinction was taken away.
Taken away. They could be merged into one, right? You did have an onslaught of what I would say complex financial products, right? Credit default swaps, ABS CDOs.
And what are those things?
Yeah, historically the environment was very much a kind of cash environment, right? If you lent money to a company, you'd actually give them sort of cash. But then to manage risk, I could sell you a derivative that would say if my loan went bad, you would have to pay me back, right? So you're just creating more and more sort of financial leverage in the system, right? The ABS CDOs probably go to the heart of your question of in my opinion, what caused it. Right, because if you do think about, most recessions in the United States are caused by major bouts of unemployment or major kind of asset bubbles, right? You can think about 91, you can think about the Russia default in 98, you can think about the internet bubble in sort of 01, but you're sitting in 2007, there was a massive housing bubble, right? And that housing bubble was 100% fueled by the subprime mortgage market. Right, because it was super easy to go get yourself a mortgage loan, right? You and I were talking earlier today, The first apartment we bought in New York City, I literally called some mortgage broker. I gave them like 3 pieces of information. The only comment other than they said approved was you should borrow more money and buy a bigger apartment.
Take more money.
There was no income verification. There was none of these things. And now if you get a mortgage today, the stack of paperwork is kind of this high. Right, so there was a lot of speculation and there was a lot of kind of push on that subprime mortgage market. You go kind of a step further than that, is those subprime mortgages were being bought by the Wall Street firms. Those Wall Street firms would immediately securitize those. There was no alignment of interest there, right? So you would buy the loans, you would look to securitize it, you look to make money, you had no skin in the game, right? That was kind of a real problem. And then you had this product called ABS CDO. So CDO is a collateralized debt obligation. People should know what the ABS market is, but that's the securitization market. They were packaging together portfolios of these residential mortgage-backed securities and creating more financial products. So instead of that one loan being owned by a bank, now that loan is spread out and it's levered probably 50 times. Right? So just a tremendous amount of leverage in the system on the financial product side. At the same time, the banks themselves were probably levered 25 times on average.
So the question is, who was enabling this building up of debt upon debt upon debt? Who was enabling?
Yeah, I'm not sure enabling's the right word, right? I think you had a fairly benign economic environment, right? I think the country had a view that housing was the one asset class that never went down. Yeah. Right? Most people on the credit side believe that people would never not pay their mortgage. I think what you actually saw during the financial crisis is people were paying their auto loan before their mortgage, right? Because they needed to get to work, but you can default on your house. And in the United States, mortgage is effectively non-recourse debt, right? So that they can't chase you kind of thereafter. So I'm not sure it was enabling as much it was the system was getting more sophisticated. The capital markets was open for it. That ABS CDO product probably really created multiple times, tens of multiple times of leverage in the system, which was kind of a driver. For those of you who, kind of want to dig into that a little bit in a more fun environment, go home and watch The Big Short, right? It's a movie. It's actually fairly enjoyable. It gives a pretty good summary. Go read the book, kind of too big to fail. But this is going to be a history event, right? Because I think you have the Depression, and then you have the financial crisis, right? They were, the financial crisis ended very quickly because the governments injected a tremendous amount of money directly into the banks in the United States, and they removed that fear.
So there is a vulnerability here, right? There's a vulnerability. So what has been done to address those risks specifically? What risks exist and how do you mitigate those risks to prevent another GFC?
Yeah, well, number one, I think the regulatory environment has changed dramatically, and I would argue it's kind of done its job, right? You had Dodd-Frank, which was a major piece of legislation that came out that was intended to restore financial market stability. You had the Volcker Rule come into effect, which really didn't allow banks to play in prop businesses, right? So you took risk out of the banking system. That I think had a pretty meaningful impact. You had concepts like risk retention come into play. If you remember what I said before, banks could buy the loans and sell them. They can't do that anymore. The originator of the assets needs to have skin in the game. Alignment of interest clearly matters, right? If you own the bottom tranche of a deal, you're going to be pretty focused how the rest of the deal is going to perform. So, I think that regulatory environment changes, while I think they were hard for banks, and I was at a bank while they were all going on, I think they did, in many ways, stabilize and reduce risk in the system. I think if you just look at some of the numbers today, if banks used to be levered 20 plus times, they're probably levered, 10 times today, right? Banks used to talk about wanting to make 20+% ROEs, and now banks are talking about making more rational kind of, lower double-digit sort of ROEs. I think the business models of most banks, due to consolidation, are broader, right? You look at the likes of a JP Morgan, who has like a wonderful consumer finance business. In addition to it's an extremely well-run bank. You've got big asset management divisions in some of these banks. Yep. So I think they've moved into kind of more stabilized business models. I think the regulatory environment, while hard, remove some of those excesses or some of those alignment of interest challenges that existed.
Yeah, but I think the problem with regulation is finding the sweet spot, right? That's the Goldilocks problem on regulation. Right? And do you think we are there yet, or do you think we over-regulated? Do we have we under-regulated? What in your view, what do you think?
I think there's probably always refinements. I think if you do follow the news flow lately, the Fed had a fairly aggressive additional capital requirements that was coming down the pike for banks. I think the banks were unified and it was too severe. I think the Fed realized that. I think a lot of that's kind of been unwound. Okay. But I think they have created an environment today where the overall financial system is more stable and more sound than it was in the past. And I think that they've kind of done their job the way they wanted, intended to do it, and I think it's kind of worked.
But then in recent times, we've seen instances like Silicon Valley Bank going bust and First Republic. And so do you think regulation has been enough on that dimension? What do you think?
I think so. For those of you who haven't followed that, so Silicon Valley Bank went under probably March of 23.
Fairly recently.
Yeah. First Republic failed on the other side. I do think one of the challenges that banks do have these days is a mismatch between their assets and their liabilities.
And that nothing regulation can do that.
No,
right?
That's just a fact of the way banks are run, right? The banks are generally taking in deposits. That money can be redeemed at any sort of moment. They're making loans that are longer. I think there is a lot of regulation around liquidity tests and how they're sort of managing that. But I do think the environment the environment's different today, right? 25 years ago, if you wanted to go get your money out of a bank, you'd kind of drive in the bank, you'd have to fill out some paperwork, you'd take the money out, you'd have to drive to another bank. The friction cost of the time to do that was very high. Yeah. If you think about Silicon Valley Bank, somebody, who I'm going to blank on the name, sent a tweet that they were worried about the financial health of Silicon Valley Bank, $40 billion left in 4 hours, right? So this asset liability mismatch, I think, is a challenge, and I think it's a challenge for how they kind of manage through that. First Republic was probably more of a story of a good bank in a bad neighborhood, right? And the other thing that was, we'll call it a big sea change. You had a gigantic interest rate move, right? And for banks, First Republic would have been a big story of this, and SVB too. They were making mortgage loans at 2%. All of a sudden, the short term's at 5%. Like those were big money losing kind of loans, right? So I think that's a hard environment. But I think what you have seen is consolidation, right? Before the financial crisis, there was 8,000 banks in the United States. There's 4,000 today, right? I think there'll be 2,000 in 5 or 7 years, and I don't think that's bank failures. I think that's consolidation to be more stable on the asset liability mismatch point, to get redundancies out of the system, to create a higher return on equity for their shareholders.
Well, in terms of the market's response to this new playing field, these new rules that have come out, which parts of the market and the businesses have grown, and why? Why do you think that?
I think one common misnomer is that the banks have shrunk. Right? The banks have actually grown fairly meaningfully during this time period. The whole marketplace has grown meaningfully. I think you can argue just the bank share has changed. If you put your finger on that a little bit, that's driven, I think, a lot by probably the monetary policy the Fed had, how cheap money was. You've got a bunch of growth in the system, but the system has grown. I think what you have seen, though, is more and more capital moving, away from the banking system into either firms like ours or the insurance space, where just the end investors are looking for outsized returns and willing to get paid for that kind of illiquidity premium. Okay. Right? And you think about the businesses that we're in, most of our investors are large institutional investors. They're state pension plans, they're sovereign wealth funds. They are not liquidity concerned, so they are willing to put their money into more longer term tied up vehicles from a liquidity perspective and earn those excess returns.
Wow. Okay. So we've seen these new private credit kind of firms come up, what we call alternate investment firms, right? in the last 5 to 7 years. The growth has been considerable. These alts, ALTS, alts for alternative firms, right? They function outside the traditional banking system, totally outside. How have they altered the credit landscape? Okay, meaning the way borrowers borrow money. And also, why didn't they have a meaningful presence before this? Why has it been a fairly recent phenomenon?
Sure. Well, I think that alts term, it has turned into kind of its own sector, right? Most of these large firms, KKR included, are now publicly traded, right? So while I think you are correct in saying it has moved outside of the banking system, these firms are probably more transparent today because they're publicly traded than they have been before, right? And most of these firms have been on this journey about not being private equity only anymore, but being involved in sort of other asset classes. I think, though, if you take a step back on this, go back to what I said about Dodd-Frank, right? Dodd-Frank didn't just put additional regulations on the banks. It also made it, I would say, a little bit more difficult for companies to either go public or want to be public in terms of financial disclosure. There was actually something popped up on my Bloomberg feed today that Jamie Dimon was out there saying they need to make it easier for companies to go public in the U.S. But that was a ramification of this Dodd-Frank change. What that did mean, because capital is always going to find the inconsistencies or where the challenge markets are, more and more money was raised from middle market private equity. So this isn't the likes of KKR and the Blackstones. This is same business, private equity, but buying smaller companies. Think about companies that might have 10, 20, 30, 40, $50 million of earnings. Those numbers are bigger today, but that's probably where it started. Those companies that they were buying needed to get financing.
Yep.
Right? So now you have a void in the market because I don't think the banks ever wanted to provide that financing. Like the big banks have been in the moving business for a long time. They want to underwrite risk and distribute it, right? They're not in the storage business.
They don't want to hold it.
They don't want to hold it. So, capital was raised to address that, right? And you're specifically talking about the direct lending market now, okay, right? Capital was addressed to do that. And now we're in a scenario where, the old asset allocation model that I'm sure you've taught in classes here, if people have taken, it's been that 60-40 split, right? You put 60% of your money in public equities, you put 60% of your money in public fixed income. Net, you're always going to kind of win because you're sort of diversified. I think that model, with the big rate move of the last couple of years, proved to maybe not work. But I think that model has now gotten much more sophisticated, where people are getting more granular, that looking for that additional yield. They were probably hunting for that additional yield when rates were low. So now all of a sudden people started lending or providing capital to firms like ours to be in the direct lending business. So you now have a supply of deal flow, right? Where these companies need sort of capital, right, and now you have lenders who can provide it. And now you've gone on this little bit of a cycle, right? As we've raised more money, we can lend to larger companies. I think you were in an environment probably pre-COVID where companies would get to a certain size, they would leave the direct lending market and they would go to the syndicated loan market. I think that dynamic's changed, right? I think during COVID, a lot of companies would have been top of their game in terms of revenue, and all of a sudden revenue went to zero.
Correct.
And then they would have to go to their lenders, they'd have to ask for amendments or waivers or other things of that nature. They would realize that because the bank's in the moving business, they have 75 lenders. The CLOs, so collateralized loan obligations, are big players in the loan market, right? So they had to go talk to all these people. So it used to be that people would access us because they wanted certainty of execution, but now I think they also want to know their lender.
The coordination with a single lender is so much easier than having multiple participants in a syndicated loan.
For sure.
Right.
And I do think, for those of you who follow kind of the news flow out there, I do think private credit has gotten a lot of attraction in the past couple of years. Honestly, we tell people we think that attraction in some ways has been too much, right? This is not a new asset class, in my opinion, right? GE, CIT, others were lending money, a long time ago. Arguably the loans banks made a long time ago where they just kept on their balance sheet, you could argue were private credit. BDCs existed, well before the financial crisis. It just has scale now.
So talking about scale, can you give the audience a sense of how big the private credit market is? How many billion or trillion or,
Yeah, well,
ballpark number?
I would break it down like this to start. So most people, when they say the word private credit, they're really only talking about direct lending, right? And we've been on this, mission for some time now to educate people to be, it's broader than that. We have a broader business. It's much broader than just that. But if you go into kind of building blocks, the direct lending business we think is about $1.5 to $2 trillion. Right?
That's significant.
Significant. Now, the syndicated loan market and the high yield bond market are kind of similar sizes, right? But what that's mean is this business has become on equal footing to those two other markets, right? And I think that that's important. Now, when you go beyond that, though, right, we talk about the asset-based finance market, which that's the other part of our business, as roughly $6 trillion today, right, going to 7, 8, 9 trillion on the forward. There's numbers out there that we would generally agree with at the overall private credit market. But again, that's a pretty broad term. Could be upwards of, 30, 40 trillion dollars, right? So this is a big part of the economy.
And it's not going away anytime soon.
It's not going away. And I think the way the business has been formed of having these long-term institutional dollars in there that just can't pick up and redeem, again, go back to this asset liability mismatch has been a key kind of part of its success and will be.
Okay, so in some sense, people get the feeling that private credit is this unregulated, front. And so do you think private credit, because it's unregulated, it's like the Wild West almost, do you think it can cause or it can spice up spillover risk into the credit markets as a whole? And, will there be more regulation? Will there be more oversight on private credit? And ultimately, who's going to pay for this? We know Mexico is not going to pay for it, right? So
Well, I don't think it's the Wild West.
You don't? Okay.
We'll kind of start there. It is a real topic. It's a topic that's out there. I think it's incumbent on the industry to kind of educate its various sort of stakeholders. I do think that education starts from the beginning of saying this isn't really new, right? Everything that we've done has been sort of done before. It is being done at a different scale, and we sort of acknowledge that. Right. I think you look at the leaders of these businesses at these various firms. They've been doing this for a long time. Most, if not all of them, have worked at a bank at one time or another. So there's, I think, sort of real training sort of attached to that. I think the industry has done a good job, but probably can do a better job on what I will call sort of best practices. We are pretty focused on disclosure. If you go to our publicly traded BDC, we literally list out every position that we own.
I know. I've
right?
seen
That's
it.
pretty detailed. You go to reports we're giving our institutional investors, there's a case study on every deal we're doing, right? But is that enough, or is it consistent enough? Most players, including ourselves, use third-party valuation providers to mark the portfolio, right? So the deal team is not the one kind of only providing the mark. The deal team is working with these independent providers. That gives good comfort to our investors as they know sort of transparency is there. So I think we've got a lot of good and best practices, but I think we have to take it to the next level. I think we as an industry are talking about that. There are trade groups set up.
And educating the public. Right?
Yeah, I think it's educating the various stakeholders, right? And, I think the other 2 points that are important is one, the industry is set up with this long duration sort of capital, right? You think about why all of the regulation does center around the banks, because you do have deposits. Those deposits are, government guaranteed. You have to have kind of rules in place to have some safeguards around that, right? I think that's a pretty rational sort of piece of the puzzle. Our money is all coming from these institutional folks. Even if it's a wealth product, there's arguably very limited redemptions that are available now. You look at the leverage that's in these vehicles. I mean, our BDC is levered 1.1 times. Our funds are levered kind of 1 times max. Right? So I think
it's small, yeah.
So, in some ways, and I'm biased, so keep that in mind, right? But in some ways, I think all the evolution of the market that has happened and how this private credit industry has grown has actually created a more stable environment Like, we want to be involved in the market when the market has significant volatility. That's a time we're supposed to sort of outperform, right? So we're kind of an all-weather lender. And I think that, enables credit to be available to companies and to borrowers, even in times of meaningful market distress.
Great. So now I want to move on to a topic that has more importance for a lot of the college here. The College of Business has an annual Year of Learning topic. And this year, the Year of Learning topic is the impact of AI, artificial intelligence. How do you think artificial intelligence is going to affect your industry? And in particular, how will it affect KKR, or is that going to be a top secret here? So.
Yeah, I don't think top secret. AI is probably without a doubt going to be some of the most impactful technology in any of our lifetimes. And that's with having lived through kind of all the changes of the internet, sort of, et cetera. I do think the actual impacts of AI is in its early days, right? I think a lot of it's still in the lab. I think the amount of things that are actually being done at it are probably, I'm going to not use this word for the long-term effects, but where I think it is today, probably overhyped versus the current kind of use cases, or maybe where some of the valuations on these names are. But undoubtedly, I think it's going to have significant changes in the world, right? For us directly, we are trying to use it today to be more efficient as we think about research, about companies, about specific sectors. We are using it to make our LP or client experiences better. I think the biggest impact in financial services today is actually call centers, right, which is not kind of our space, but if someone had a problem with their credit card or they have a problem with one of their sort of mortgage payments, that is a great tool. I think that's going to make that sort of much more efficient, make that a much better sort of process. Yeah. I think the real impact today is the amount of money going into the data center space is significant, right? It's turned into a small asset class to kind of a very talked about, very kind of center of the fairway. Some of these things cost $1 billion right now.
A single data center costs $1 billion to set up.
Right, so you think about that, and this is being fueled by AI and where it's going. And then the thing that nobody is probably spending enough time on is the power needs that relate to this, right? And I had the benefit of being at this Morgan Stanley event last night on digital infrastructure, and their team was going through various things. I'll probably get some of this wrong, but Microsoft has talked about building this gigantic sort of data center. I think it might be sort of 10 times the size of the normal one, just to power that, and it's just regular computing power, so no backup, no redundancy, would take the power of all the power being used in New York City and Chicago, right? The regular data center is taking the power of sort of Houston, right? So that doesn't mean it can't be solved, right? We have more natural gas in this country than we know what to do with. We're exporting it. Solar's gotten a lot of real tailwinds attached to it. But there is a gigantic capital need to sort of change this. I mean, Microsoft, made the headlines the other day. They're actually going to bring back on a nuclear power plant that's been decommissioned for, 40 plus years. So, I think this is the long game, not the short game. I think you're getting the data centers being built. You're getting a significant need for computing power, which is kind of driving that. Everything's up in the cloud. The algorithms are getting more complex, but you got to find a way to power them. Right.
And a lot of data centers need redundant power systems, right? In case the main power system breaks down, you need more power.
For sure.
So we're talking double the amount of power that you just talked about.
Yeah. And I also think there's other things. I mean, we've looked at deals where, we can take old kind of coal mines that are sort of being decommissioned. They're already attached to the grid. That's like the big sort of point of the puzzle here. Could you put solar fields there? Could you get natural gas there? But that's a longer term discussion that, to be honest, I think is probably still in its early days.
Okay, before we move to the Q&A section, I think everybody wants to go move to the Q&A section. I just want to bring the discussion back to our Lehigh University and an initiative that you and the members of what I affectionately call the Lehigh Credit Market Mafia. No disrespect there, right? Okay. So this crew, including yourself, Paul Nollmeyer, Rob Camacho, and Greg Geiling. And then you brought on Chris Scott, Charlie Buston, and John Abramson. You've created this finance mentorship program for Lehigh. I think it's an amazing program. I've seen firsthand how much this benefits our students, as well as alumni at different stages of their professional growth. Can you please share a little bit about that, if you don't mind, in the remaining few minutes that we have left?
Sure. I mean, an interesting starting point is the four of us who started that thing didn't know each other from Lehigh, right? We all graduated at different times. We all happened to be in the private credit business. Rob was at Goldman. He was financing HPS. I knew him from when I was at DB. He was financing us at KKR. Greg's at sort of Bayview now, but it was at Blackstone before. I think the common thread was, well, number one, I think Lehigh connections matter. And I think you have a very, very supportive and very available alumni base who kind of wants to help. I think we saw a particular sort of challenge that, you know, the Lehigh Business School has done a wonderful job on sort of so many things, but we weren't seeing enough kids get finance jobs kind of early. And, you know, I think there's some fairly legitimate kind of reasons for that. You and I have talked about that at length over times.
Many times, yeah.
We weren't getting the firms on campus recruiting. Recruiting starts super early now. I think you interview for internships for finance at the beginning of your sophomore year. How could you get the students prepared? You know, so we wanted to get involved to kind of help that, right? And I think we found that, you know, I think there's more than being alumni than just kind of, you know, writing the check. But, you know, no difference than the speaker series, actually doing things that I think can kind of impact students. So we were happy to do that. We took it upon ourselves to start mentoring individuals who, let's call it 3 to 10 years out of college. Right? We wanted to help folks who were just really in and around New York, probably by definition. We knew we were probably too far out of touch to ourselves mentor individuals kind of in college, but the quid pro quo was if you wanted to be part of the mentorship program as the young alumni, you needed to mentor folks on campus. So now you create
it's
a pyramid.
Like an ecosystem.
I call it a pyramid.
Okay.
Right, and if there's now, you know, 7 of us, if we can each do 3 or 4 kids and they can do, you know, 4 or 5 sort of, 3 or 4 young alumni, they can do 3 or 4 sort of kids in college, you can get up to like 100 people. Yeah. And I think it's been rewarding for us. I think it's been, you know, hopefully impactful for the students. You know, some of my, you know, mentees have called me as they made job changes, right? We've talked about, you know, next steps. We've talked about what they wanted to do. I think it's been a good program. I think it can do better, but I think we got a lot of support behind it, not just from the alumni, but from the university itself.
So it's a system where the senior folks mentor the junior analysts and associates, and the junior analysts and associates then have to mentor Lehigh students who currently are in.
Exactly. All with the view of, I think, trying to get more connectivity to these finance students, to these jobs that would be in and around kind of Wall Street.
Excellent. That sounds like an amazing program. Just a great example of how much our loyal alumni participate and contribute to the well-being of the future generations of Lehigh students. And I think, you know, the Lehigh alums really step up. So I really encourage students who are pursuing a career in finance to take advantage of this finance mentorship program. And it all came about because of 4 people decided one day to draw some things on a paper napkin, from what I'm told. Right?
It has been, yeah.
Okay, and that sort of ends our moderated component of the Gruhn lecture. And now I'd like to hand it back to Dean Malhotra to oversee the Q&A session.
We will take now questions from the audience. You can see that there are 2 microphones on either side. So please step up to the microphone, ask your question. Keep it brief as much as you can. So let's go with you, sir.
Hello, I'm Harris Rosenthal. I'm a sophomore here. I want to first thank you guys for being here and for your time. Kind of 2-part question. Number 1, can you please talk about the relationship between Global Atlantic and KKR's private credit business and how they benefit each other? And then the second part is, what's the competitive advantage of KKR's private credit origination capabilities, and how does it compare to like an Apollo? Thank you.
Okay. Well-researched question. So, you know, I think
I warned you.
if you do take a step back, we did enter into the initial acquisition with Global Atlantic we actually announced it during COVID. It closed in February of 21. It has been strategic for us. We've actually since acquired 100% of the business. There has been a theme out there about partnerships between insurance companies and alternative asset managers to kind of drive returns, allow these people to do the best that they can from a policyholder perspective. It has been very impactful for us, right? It has allowed our private credit business to scale more meaningfully. It has allowed other parts like our real estate credit business to scale more meaningfully. I think we're proud of what we've done there. I think it's a great management team. It's a great brand at Global Atlantic. I think you asked about the origination footprint. I think everybody spends a lot of time making sure their origination is as broad as possible, right? We're covering financial sponsors. We're covering the financial intermediary channels, which is law firms, which is brokers. We even cover the banks. We also have people out there covering all the various fincos, almost any angle you can find. The one thing that we do talk a lot about is inside a business like private credit, size and scale matter, right? You need the capital to control deals, but you also need the team to be able to find those deals, right? And hence, that's 125 people on our side.
Thank you.
Thank you.
Please go ahead and ask your question.
Yes, thank you. Benjamin Pauls here. I have two questions. For one, how has private equity changed with the initiation of Act 40 funds and LTIF funds in Europe, and especially in regards to the private credit business?
And so on the first question, obviously the historic framework for private equity funds was to raise that in a traditional sort of GP, sort of LP structure, right? That was the kind of core of that business for a long time. I think your question's referring to these other sort of means where other types of investors can get access, to those types of vehicles. I think that's a big theme for the market, one that I expect continues. And this is what we talked about a little bit with Fernando. I do think that the real driver for the initial growth that private credit saw was the growing kind of private equity market that needed financing, right? We didn't talk about this, but we would estimate there's a similar amount of dry powder on the private equity side, right, who's kind of waiting to buy companies. If anything, M&A volumes have been at historic lows, right? You had this gigantic move in rates. You had really a disagreement about valuations. Was there a willing seller, willing buyer? But you got a lot of dry powder there, and now you have the capital to sort of finance it at the other side. But I think that was the real driver of where this direct lending and private credit market grew.
Thank you. My second question goes towards more of an economic perspective in general. With the growing fear of recession in the U.S. and the most probable upcoming recession in Europe, how do you think the market's going to shift in terms of investments?
Well, interesting. I think the market seems very unsensitive to kind of big, events, either economically or geopolitically. I mean, you do have a pretty dicey situation out there, right? You got multiple wars. You've got a consumer who may potentially be over-levered. I do think, though, I think you have to give the Fed a compliment, a significant compliment, right? You had a meaningful move in inflation that you could argue was directly related to the pandemic. I think all the government stimulus probably was not needed, but definitely some stimulus was needed considering what was going on. They aggressively increased rates. They did that without, tipping the economy over into a recession. I think we've gotten to the point where, the big conversation has been hard landing or soft landing. I think we've gotten to the point where most people believe the hard landing is off the table. I think that's correct, but I think people need to be mindful of monitoring risk. I think you now have a question of, is the consumer over-levered? It is a consumer-driven economy. I think you're correct. Europe is probably weaker. Germany, which used to be the main economy over there, is kind of struggling from a growth perspective. So I think it's going to sort of play out. I think the lowering of rates is going to help, right? Again, but I think you have to bifurcate the markets. The equity market's kind of its own game. And then the credit markets, credit markets right now are probably as strong as the equity markets, but I think that they usually are the first ones to take a step back if they see risk sort of presenting itself.
Thank you.
Your question, please.
Mr. Pietrzak, I just wanted to say thank you for coming and speaking with us. My question was, what do you think the future of the asset-backed financing and securitization market looks like, and how that differs at a mega fund like KKR compared to a bank?
That is an area that I think we're pretty focused on in terms of sort of growth. If you do think about an asset class like direct lending, we're probably in the middle to sort of later innings of that. I think that market will still grow as deals get bigger, but it's becoming more mature. There has not been a lot of scaled capital raised in the asset-based finance market. I think we're excited about that. I think we've been doing that since 2016. We've been fortunate to have real scale there. The question about the insurance company, that's been quite impactful for us there. So I think that trend sort of continues. I think that's where probably the big growth of private credit is. I think there is, these markets do partner together very well though, right? Because even though, we may be buying certain assets from banks because they are capital punitive, banks finance us tremendously either against our direct lending funds or probably most specifically in the asset-based finance market, right? So I think it goes back to this regulatory point. We're probably sitting at the bottom of the capital structure. They're sitting more at the top of the capital structure. But if you think about banks being smarter with their balance sheets, if you think about corporates being smarter with their balance sheets, wanting to be more asset light, you think about technology and driving sort of consumer finance. This isn't a big market for us, but you can all get a loan on your phone right now for probably almost anything that's kind of out there. I think we're pretty bullish on the growth.
Great, thank you.
Your question, please.
I'm a sophomore here. I'm Jake, I'm a sophomore here. I'm also a part of Scholars of Finance, so first and foremost, thank you for supporting our organization. But as for my question, as a Lehigh student competing against these huge target schools, what do you think the best thing we can do to, if not gain a competitive advantage, at least play at an even playing field with these target schools when it comes to breaking into the industry?
Well, first, congrats on the Scholars of Finance thing. I think the Lehigh chapters, I heard 75 kids today from kind of a starting spot of probably 0 a handful of years ago. So I think it's a great organization, so congrats for that. I do think, for finance particularly, I do think it's going to require a little bit of extra work, right? A little bit of extra diligence, using that Lehigh network, probably being over-prepared. If you're interviewing at XYZ firm, find someone who works there, right? I'm sure the Lehigh Connections website can help with that. LinkedIn can clearly help with that. But maybe a little bit more kind of elbow grease versus just kind of coming out of Wharton. That said, I think the overall Lehigh Business School provides an excellent sort of foundation, right? I think we've seen, on my side, we've got 2 Lehigh sort of folks who've joined the last couple of years. They've been excellent sort of performers. I think they come well prepared. I think they're kind of well balanced in both the kind of technical, sort of skill sets as well as the social kind of aspects to succeed. Your career, your job is much more than running a model, right? You need to work on internal networking. You need to work on external networking. So I just think you got to lean in a little bit more, and I think people probably need to understand that these recruiting processes are starting much earlier, and I'm not sure there's anything that's going to slow that down.
Please go ahead, sir.
Yeah, I'm Moose. I'm a senior here. Again, thank you for your support to Scholars of Finance and your time here today. So you mentioned earlier today that times of market volatility is when you learn the most. As you reflect on 2008 and the more recent COVID crisis, what are a few key learnings that come to mind?
Well, undoubtedly you learn the most, right? Because when everything's going up and to the right, nobody's making mistakes, right? And you kind of learn from your mistakes. And, I remember sitting on the kind of the trading floors of Deutsche in London, which, those trading floors were probably 2 or 3 times the size of this room, and you're just watching the TV and you're watching kind of banks kind of fail. I do think you learn a little bit about, history repeats itself in finance, so what were the mistakes made so you don't sort of repeat them? I think there is something to be said about being kind of calm in this time of market volatility. I think the folks who had lived through the financial crisis handled COVID much differently than the folks who didn't. That was a little bit of a different thing because nobody knew, really where the end game was going to be. But you're going to have tough times in your career. There's going to be tough markets. I think you're supposed to lean into those, right? Because I do think you always have to kind of learn. We were talking at lunch with the student group. I probably have not been a curious enough learner kind of over time. So I would kind of lean into that. I'd be leaning into things that is not your area of expertise, but you're going to learn from your mistakes, and your mistakes are going to get exposed during events like the financial crisis.
Thank you.
We have time for 2 more questions, starting with you, sir.
Hi, my name is Tyler, and I'm a freshman. I was wondering, based on, you talked about AI briefly in the presentation, and I was wondering if you think there's a short-term bubble around stocks in the kind of area in the field.
To be honest, I'm probably not smart enough to have like a perfect view. It seems like there is, right? Because these things are trading at valuation multiples that are at epic proportions. That said, those probably same conversations were around what's it called, the Magnificent Seven, sort of today over the last sort of 15 years. There's clearly more risk, right? But you're getting paid for that sort of risk. I think the one thing that might be different today versus, let's call it the internet bubble of 2000, 2001, 2002, or even kind of some of the VC bubble that we saw, leading up to kind of the meltdown of 22. A lot of those companies never made money and were never going to make money. So it was really hard to justify those valuation multiples on a long-term perspective. I think these AI businesses have the ability to kind of more rapidly kind of go from red to green as it relates to the income statement. But I think it's speculative right now.
Thank you.
Hello, my name is Mia. I'm a sophomore student here at Lehigh. You talked a lot about the significance of the asset liability balance and how that contributed to the downfall of the banks, especially in times when the market is constantly shifting in volatility. How do you approach unrealized gains, especially when you might be considering them as collateral for potential investments?
Yeah, I think there's a different answer for that depending on probably what type of pool of capital you manage. Everything in our side, and I think this is one of the benefits for this, we clearly care about mark-to-market tremendously. We report gains and losses to our investors on an unrealized basis, at least quarterly. But at the end of the day, we're most focused on what's the end result for that investment. I think the one thing we do have to think about in this business is it is usually prudent risk management to take some risk off the table if you've made a lot of money, right? And that doesn't mean you have to sell it all, right? Maybe you sell a third, maybe you sell half, but maybe you take your cost basis off the table. So I think that goes into, our job inside of private credit is very different than, private equity or venture capital and sort of what their goals are. Like ours is about downside protection. We cannot afford kind of big losses in the portfolio. So if you have those winners, you have to do it where, venture capital funds could have a lot of investments that were zeros, but they could have a bunch of investments that could have made 10 plus times their money. Right? We don't have that luxury.
Thank you.
Thank you.
With that, we conclude our event today. But before we do that, thank you all for attending the 2024 Donald M. Gruhn 49 Distinguished Finance Speaker Series. Special thanks to Don and Judy Gruhn, whose continued generosity makes this series possible as we strive to expose the students to thought leadership from around the globe. Thank you to Nandu Nair for his moderating skills, and to Dan Pietrzak for sharing his thoughts and experiences with us here today. Thank you all for joining us.